Well, earnings season for big tech is about to kick off. On Tuesday, we'll be hearing from Alphabet, Microsoft, and Snap after the close. And later in the week, we've got Meta and Intel on tap. Joining us now is Daniel Flax, Neuberger Berman Senior Research Analyst. Daniel, thanks so much for joining us. I want to kick us off with some of these overheated names. A lot of the big tech companies right now seem a bit overheated in this environment. You can just take a look at Meta shares. They're up nearly 150% year to date. How does that set us up heading into this week?
Good afternoon. Great to be with you, as always. I think the setup in the very near term is the market is worried about slowing growth, the impacts of inflation, higher interest rates. But if we step back and look at each one of these companies, Meta is focused on transitioning their business to more short-form video with Reels. We're continuing to watch that closely. Google, which we'll see tomorrow, I think what will come out of it is that search is durable. YouTube, I think, remains a valuable platform, and there's good opportunity with the Google Cloud platform. And then I'll round it out with Microsoft, where I think they've continued to execute well with Azure. They're well positioned for next generation workloads in key areas like AI. But of course, they too will have to navigate what is a difficult environment.
Daniel, let's start with Microsoft, because that has been one of those names that has really benefited on the back of this AI exuberance. I think the exuberance is still the right word here. What will it take for the market to push this stock even higher, just given the run-up that it's had already?
What's interesting with Microsoft is they've been investing along with Amazon and Google. These companies are investing tens of billions of dollars a year in research and development and capital expenditures. And so what I think the market will need to see is visibility on strong growth later this year and into 2024. This is being driven by the health and really the durability of key platforms like Azure. We saw with the pricing announcement last week on Copilot that they're investing a lot in key areas like generative artificial intelligence. And then on the other side, if they can deliver value to users, then users will pay, which can ultimately contribute to strong revenue growth and free cash flow generation for Microsoft in the year ahead.
And Daniel, last quarter, it felt like just the mention of AI would send a lot of these share prices higher. What more do you think investors need to hear from these companies this quarter in regards to AI and the implementation of AI within these businesses?
When we speak to customers, there's a lot of anticipation and excitement about the potential of artificial intelligence as one example. Really, it's this larger build out of the digital infrastructure. What we're going to need to see from the companies is consistent execution on their product roadmaps, new product announcements, new offerings, really their ability to scale these offerings across their customer base over the coming quarters and really years ahead. So it's relatively early, but what I think the market is going to look for is signs that these cloud giants, in the case of Microsoft or Amazon or Google, they can innovate, they can invest, and really create opportunities for their end customers to grow, which of course helps those platforms themselves.
Let's talk about what we're seeing later this week. Meta is one, Snap another one. Certainly a good pulse on what the digital ad market is going to look like. It feels like the expectation has gotten so low, given the slowdown we've seen on that front. Could we potentially see an upside surprise from a name like Snap?
Well, with Snap, and we continue to follow the name closely, they have a lot of, or they've delivered a lot of innovation to users. What we're looking for is more consistent execution from the company. I think in terms of the user population, the teens, 20s, and 30s, they've done a good job. I think they need to continue to evolve the platform. They need to remain relevant to users. And so we'll look to see the health of their user base and their ability to innovate. In the very near term, the environment remains difficult, but again, I think that's widely appreciated. The question is, what can they do on a go-forward basis, which is what we're watching.
Daniel, as you look ahead to the back half of 2023 and look at the environment that we're in right now, what do you think are the biggest risks to some of these tech names?
There's clearly macro risk. There's cyclical headwinds. There's trade tension. There's geopolitical tension. There's a lot of cross currents that are out there that we are, of course, watching closely, and we're seeing how these companies navigate them. I think what's going to matter most to some of the companies that we're talking about, be it Microsoft or Google or Facebook, or excuse me, Meta, is will they be able to execute on their product cycles through what is a challenging environment? If they're able to do that and the market sees increased visibility on better growth in 24 and beyond, then I think that can set the stage for outperformance. But it is a challenging environment, but innovation and growth are where we remain focused.
Finally, Daniel, given how frothy some of these names have gotten, any particular stock that you think could provide good opportunity as we go into this, the thick of the tech earnings period?
We like Google or Alphabet a lot at current levels. I certainly appreciate the macro concerns. There's a lot of questions around their competitiveness with ChatGPT and Bing. But what we're seeing is that they are bringing out new offerings like Bard in the area of generative artificial intelligence. And their relevancy with users and with advertisers, I think, is going to only increase as we go through this period and come out the other side. I think the YouTube platform will see better growth later this year and into next year, partly as the compares on that business ease. And I also think the Google Cloud platform is very much underappreciated. So you take these three pillars and look at the cash generation that I think we'll see out of the company over the next 1 to 2 years. And I think that makes for a very interesting setup at current levels.
We'll see if these companies can deliver. Daniel Flax from Neuberger Berman, thanks so much.